Good evening, everybody. This is Professor Hassey. It's our week 7 Friday update or weekend update video. Today's date is Friday, December 9th, 2022. And our subject tonight is I have posted the solutions and grades to the latest assignment. And we'll go over that because you'll have a similar problem on your final examination, which will be posted next Monday. We have a review session tomorrow with the study guide that I've provided you for the final. It'll be at 9 o'clock tomorrow morning via Zoom. The link is in Blackboard. And I'll be recording that session if you cannot make it and posting it to Blackboard and YouTube later on. So as you know, just a quick update, here's our assignments file folder with that study guide. And here are the solutions to the capital budget case assignment number 3. And the grades have been posted to Blackboard. Again, as we head into the final week of our class and final examination, I urge each and every one of you to review your grade average in this class, review where you might have some holes in your grades where you didn't post an assignment and didn't for whatever reason, and you have a 0 or a very low grade. You might want to make sure you're aware of that and what influence it has on your grade. And if you need to talk to me about it over the weekend or into next week, please do so. Do not wait to the last minute. The final examination will be posted on Monday. It's due Sunday, December 18th. Your course evaluations are due December 20th, and the grades will be posted to Blackboard on Thursday, December 22nd. And that gives you basically 4 days to review all that. Review your grade status and the grade in your course, because I will be posting the grades to the registrar's office at the University of La Verne on December 26th, Monday. So from the 22nd, the day you see your grade in Blackboard, to the 26th, if you have any complaints, some beefs, some whatever, you have a few days to get to me and work things out. So please be aware of that. Grades will be posted to Blackboard, but then it'll be about 4 days until I officially post them to the registrar's office. So just so you're aware of that, that's a good thing to know, especially for those of you who have some openings or some holes, I like to call it, in your grade status in this course. And we can talk about it. Okay, good. Let's see. Let's take a look at the assignment number 3 solutions. Okay, we are given a 5-year project with an investment of $750,000 with a 5-year depreciable life with a salvage value in year 5 of $25,000 and a straight line depreciation of $150,000 a year to fully depreciate that asset at the end of 5 years. It's projected in this project to sell 40,000 units every year at a selling price in year 1 of $40 a unit. That'll be inflated at 4% years 2 through 5. The variable cost per unit is $30 a unit in this project, and that also will be inflated at 4% years 2 through 5. And the fixed costs that have no bearing on unit production, but have a flat fee or cost every year, is $175,000. That also is inflated at 4% a year. The project cash tax rate is 22%. Its WACC is 9%. And the working capital is based on a 10% of the next year's sales. So putting that all together, we end up with $1,295,065 in total net cash flow generated years 1 through 5 of this project, with a total investment of $750,000 in year zero and an additional $160,000 in working capital for a total investment in this project of $910,000. Some of us forgot about the salvage value in year five. It's a $25,000 salvage value, but since we fully depreciated the asset over its life, that means we have to tax that as a gain on the disposal. So we take 22% from 25,000. We get 19.5 as incoming cash flow in year five. So as you can see, we're taking the $1,295,065 and discounting it back to year zero at our cost of capital of 9%. We get a discounted cash flow of $975,265. That, as compared to the overall investment in year zero, gives us an NPV of $65,265. An internal rate of return of 11.41%. A profitability index of 1.07, and a payback in a little bit over 4 of the 5 years, 4.13. Notice my dollars are all whole numbers, no cents. Notice my decimals are all to the 100th decimal point. Please note that for future work on your final. Should it be a go or a no-go? Well, some of you put no-go, and rightly so. They're not making much money off this project. It's costing them 9%, and they're only making 11.41. So technically, yes, you do have an argument for a no-go on this project with not that great of a return. But since it is profitable, since it is positive, then go is the generally accepted terminology to go proceed with this project. But in the real world, that would be debatable. Many companies would want a higher return. Why do companies build their products in other countries besides America? It's cheaper to build them. And many times their returns off the asset will be higher if they build their products outside of America, China, Australia, India, Indonesia, South Korea, wherever. And that makes it for why American products are made overseas. That's cheaper. So this is part of that analysis to determine that. Where do we get the greatest value to produce this capital investment of $750,000? So that's the solutions for assignment 3. If you missed an inflation rate, you probably got an A-. If you missed a couple of variables, you probably got an 85 or a B. If you made an attempt and didn't do the return analysis calculations, you probably got us in the 60 range. So again, check the solutions. You're going to have a similar problem like this on your final examination next week. So make sure you have this under your belt for a future problem going ahead in the future. But overall, we did very well on this. Very well. I think the template helped naturally, but you had to do your own math and own arithmetic and own calculations. So the class did very well. So I'm pleased. Another topic for this week is our final examination, which will be posted on Monday. We have a review session, as I said earlier, Saturday morning via Zoom beginning at 9 o'clock. So coffee will be on, maybe donuts. And it'll be covering some of the material of especially the latter chapters, 16 and 19, capital structure, dividends, cash flow management. Also be going over some of the review of the key points of the class, capital budgeting analysis, definitions of finance, and maybe some key financial statement review. So we will talk about that in our review session Saturday morning. It will be videoed and will be posted to Blackboard if you cannot make it. Remember, the course evaluation is now in process. There are the links to complete that if you would like to begin thinking about that next week. Also, the final question of the examination is to update your portfolio as of Wednesday, December 14th. So let's take a look on how we would do that. Here's my portfolio the last time we did our evaluation, November 18th. Now we're going to be doing it as December 14th, and we're going to be doing basically the same, but we're going to be adding one additional part to this, and you're going to be telling me if any dividends have been paid by your company over the 8 weeks that you've owned this stock. And that's simply by going to Yahoo Finance, going to historical prices, and you can see the dividend payouts in the last few months listed, if there were any, by your company in that area. So you can go to historical prices in Yahoo Finance, and if you did pay a dividend from October 28th to December 14th, you need to record that in the dividend column provided in your spreadsheet. So again, what I would do on December 14th at the close of market, I would just copy this down, paste it, make the date now December 14th, 2022. And this is the update. So I would change this date to 12/14. Not typing very well this evening. Too many Christmas parties. Copy that down. And then on Wednesday, I would get our new prices. Now, since I've already did this last time, taking the shares times the price, I already have that formula here, so that would copy down. So now I would find the new share price on December 14th, just type it in there, and automatically my portfolio will be updated. Then you would have to fill in the dividend section. What did Apple pay a dividend from October 28th to December 14th? And it'll be listed in the Yahoo Finance, or you can go to the Apple website and get that, or just Google it. And you write the dividend that's been paid per share. You don't have to do the total, just the per share. And that, just so I have that information. We've already had the beta, which has been an important thing in our class. Then you update the Dow, the S&P 500, and the NASDAQ over the course of the period. But now you're going to be also doing something a little bit different. You're going to be telling me not only how this has changed from your original and how Dow and S&P 500 and NASDAQ have changed, but also you're going to do it calculating wise. In other words, you're going to be telling me what is the percentage gain or loss of your holdings. So how do you do that? Well, all you do is you take in a formula, you take the price or the value of your portfolio on December 28th to December 14th, and let's say it's this amount, subtract it from your original value, which will be $100,000, and divide that by $100,000. In other words, you're going to take the change in your portfolio from October 28th to December 14th and divide it by the original amount of your portfolio, 100,000, and you will get a decimal, not a dollar sign. So you convert that to a percentage, do out 2 decimal points, and geez, in this example, my portfolio has lost 3.32%. Not good. But you're also going to do the same for the indexes. Compare yourself to the market. So again, for the Dow, you're going to put in a formula, equals, parentheses, isolate the formula. So you're going to take the value of December 14th, subtract from that the value of October 28th, and divide that by October 28th. And you get a percentage, a decimal, convert that to a percent, always go 2 decimal points. And as you can see, I gained 2.69%. Now we'll just take the corner of that cell and copy it over to the other 2 columns. And as you can see, all the exchanges have gained in these 8 weeks. Dow, S&P 500, and the NASDAQ, and I've lost. So Mr. Hasse is a loser in compared to the market. I want you to compare whether your portfolio, how it performed to the overall market. Now I'm going to post this template of this portfolio to the final examination file folder when I post the final, so you can see how I want this to look and how it's calculated. But I want to see your ending value, the ending values of the indexes, and the percentage gain and loss on your portfolio for this time period, and compare that to the markets. And that's what I want to see. Post it in a spreadsheet file in addition to your other work on the final. All right. And then what I'm going to do is I'm going to go through all of our students in our class and find out who has performed the best. And that will be our Wolf of Wall Street for this session. And that person will receive an email from me asking for their mailing address so I can send them a Starbucks gift card and a nice gift from the University of La Verne bookstore. Money is no object in Business Finance 330 Online. Unlimited budget. So the winner will get a nice little Christmas gift. So please fill this out correctly, do it right, and you might be our Wolf of Wall Street. As of now, Professor Hasse definitely is not the Wolf of Wall Street, but that could be updated as of this coming Wednesday, December 14th. All right, so that's what we're looking for in the final. Okay, one of the key parts of this last area of our study is the capital structure and how companies are financed. Combination of debt and equity, as you all well know. But how this structure can be fixed or moved around. And there's an example here by if any of you listen to National Public Radio, there's a great show on every morning and every evening for 5 minutes called Marketplace, which summarizes the markets, the economy. Excellent show. I urge you all to try to listen to that if you can. They have a very good podcast as well, too, to keep you up to date on the economy. And the producer of that show has put together a series of videos, and one of the videos is about capital structure. So we're going to take a look at this video because it explains in a very easy way about how companies restructure their business. Let's take a look at that.
Hi, my name is Paddy Hirsch. I'm a senior editor at Marketplace. And today I want to talk about capital structure. The reason being because it's integral to this whole issue of swapping debt for equity or preferred stock for common stock. In order to understand how all of that works, you need to have a good feel for how the capital structure of a company works. So we've shopped around for a little analogy that we could use to describe capital structure, and here's one that we came up with. So here is your average passenger airplane, okay? All right. Okay, it's kind of a wonky looking aircraft, but we can all recognize it by the wings and the tail and the fact that this is a slightly unusual aircraft because it's only got one exit door at the front here, okay? Only one door. Here's the ramp that comes out. And the aircraft is configured along the normal lines. At the front of the aircraft we have first class, then we've got business, then we've got this new thing that you'll see if you go on board the aircraft these days, in particular American Airlines, I can say with experience, which is it's like the Coach Plus. Okay, so we have Plus, and then after that, of course, we've got Coach. Everyone in the rear with the gear. Now, if this aircraft lands heavily on the ground or crashes, all right, because it's only got one door, it means there's a very specific exit routine for everybody. First class gets out first, business class comes out next. Then it's Coach Plus, and then Coach. Everybody's going to have to come out in that order. And that's kind of like what it's like for a company whenever a company collapses, okay? Because these classes also equate to certain asset classes. So like first class are the loans, okay? Business class are like the bonds. Plus Coach class is like preferred stock, okay? And then Coach class is like common stock, okay? So why do these asset classes equate to these sort of classes on board the aircraft? Well, it's all about risk, okay? The further back in the plane that you sit, the more risk that you take, Okay, because if the plane crashes, then it's less likely that you're going to get out if the because of the priority of exit. So say this plane crashes, the loan holders get out first, then the bondholders, then the preferred stockholders, then the common stockholders. And when they get out whole, that is to say, they get all their money back. Okay, so if we look at this, these delineations here, you see that they kind of fall into two. We have debt here, which is the loans and the bonds, and then you have equity. Okay, but preferred equity is slightly different because preferred equity looks like equity, but it's actually structured more like debt because there's this payment every month that the company has to make. So all of these issues here, these asset classes, loans, bonds, and preferred stock, these guys all receive, or these people all receive a payment every month. Okay, so now if we look at this debt and equity tranche, we can see that we can see what the company's leverage is, what its ratio of debt to equity is. So say in this case we have an equity ratio, a debt to equity ratio of 6:1. Okay, it means that there's 6 times the amount of debt than there is to the amount of equity. Okay, now if a plane, even at those leverage ratios, a plane can sort of fly straight and level, no problems, as long as it's making enough money to service the debt, that's to say, to keep paying the loans, the interest rate on the loans and the bonds, and to keep paying the preferred shareholders. But what happens whenever the company starts making less money, say in a recession? Well, suddenly it starts to head towards the ground. In the case of Chrysler, it starts to go to, head towards a crash. So what happens? Well, you want to right the aircraft. And one of the ways to right it is to convert some of these issues, some of these asset classes into common stock. Okay, so you could ask the preferred stockholders, say, to convert to common stock. And what will that do? Well, it means that you don't have to pay so much every month because you don't have to pay these preferred shareholders. And maybe you go to the bondholders and you say, hey guys, would you mind converting your bonds to common stock? And if you did that, if you managed to convince them to do that, well, once again, you've reduced the amount of interest payment that you have to make every month. But it also reduces your leverage. So say, for example, these preferred guys and these bond guys, they all decided to convert to common stock. Well, what does that do? Well, it means that you've cut your leverage down. Your leverage is now down to, say, 2:1. Okay? It means you're flying much more steadily. It means you've got much more people in coach now. Okay, coach is much larger. Your equity is much larger in comparison to your debt, which means that you've rebalanced the aircraft and you're flying much more straight and level again. Okay, so what's the incentive of these people to convert their bonds or their preferred stock into common stock? Well, the incentive is that if you don't do that, there's a possibility that the plane could, or the company could founder, the company could hit the ground. And if the company does hit the ground, then we're talking about a liquidation or a bankruptcy and potentially a liquidation. And if there is a liquidation, well, you're going to have to be assessing the situation and saying to yourself, okay, if this plane is liquidated, how much likelihood is there that I'm going to get my money back? Because the people that are going to get their money back first are the guys in first class, the loan holders. Only when the loan holders are completely paid off are the bondholders going to get their money. And only when the bondholders are totally paid off is everybody else going to get their money. So if you're a bondholder, in this case, and you're thinking about converting to common stock, you're going to say to yourself, am I going to get my money back if we crash? Or is it better for me to try and rebalance the aircraft, take a haircut, a so-called haircut, that is to say, convert your bonds into equity, which is probably going to be worth less than the bonds are worth at this point, but with the thoughts that if the plane starts to pull up, if the company starts to improve, then your equity is going to be worth more further down the line. That's the decision that these people have to make, and that's the case that's made to them whenever the company or the restructuring managers or whatever it may be are trying to get people to convert from debt or from preferred stock into common stock in order to rebalance the balance sheet of the company, in order to rebalance the capital structure and make it more likely that the company will survive. Of course, the bondholders may decide, you know what? Maybe we'll wait to see what happens if the plane steams into the ground. Maybe we'll wait to see how bad the crash is. Maybe we'll wait to see what the recovery potential of the company is and whether or not I can get paid out at the end. But let me tell you, on the way down, while the plane is heading down and they're making that decision, if they make the wrong decision and everything crashes, well, it's going to leave everybody, even the first class, the loan holders, everybody very badly needing a drink.
So that's a good video explaining capital structure and kind of the end point of, or actually the end point and the beginning of our class, because we need to understand where the financing comes from, which we have done. We have analyzed what the financing does in financial statements. We've provided a return and a capital budget analysis of how that financing is determined. And now we're closing with a review of dividends and debt financing, which will continue that discussion into week 8 and our final examination. So I hope you all have a great weekend. Again, look forward to seeing some of you in our review session Saturday morning. And if not, we'll see you with our introduction video to week 8 and our final examination study. Have a great weekend, everybody. Stay warm. Bye-bye.